with all this volatility around election, we have witnessed a very sharp uptake in the markets based on the exit polls, and that entire things getting reversed yesterday, even more than that, and we have seen some pullback today. What is more important for all of us today is to really understand what is a long-term implication of all this. Is that something really we need to be worried about? Is there something we have to look for? Is any of these required any material change in our thought process, our approach towards our investments, our themes, our thought process in terms of where is the next trend happening, and how do we really navigate through entire volatility? It is very important. This NDA 3, as we understand as on today, is going to be a same government with the same rigor and same determination, or there will be some pullback in terms of their commitments towards some of the reforms. And to take this forward, I have two very, very important guests today. We have a CIO, Mr. Naren from ICICI Prudential, and Sailesh Bhan, CIO for Nippon India Mutual Fund. And we have these two veterans here, and I'm sure next 25-30 odd minutes, we will get a lot of insight, and I'm sure we'll get peace of mind after going through this entire volatility. To start with, Naren, I just wanted to understand from you, what is your take in terms of this political situation? How do you look at this situation unfolding?
I wish it was as easy as you can put the question. I mean, see, actually ahead of the election, based on my guru Michael Mauboussin, we did what we call as a pre-mortem and looked at all the previous elections. So in 2004, the market was very cheap, and the election result was completely against the market belief. The market crashed, and then the market actually rallied significantly after the market crash in the 3 years after the crash. In 2009, the market, the kind of positioning was very negative pre-election, and the market was very cheap ahead of the election. The market just zoomed after the elections. In 2014, the market, there had been virtually no inflows for 6 years ahead of the election. And there was a big bull market after 2014. And the market, particularly in small and mid caps, was very cheap on the eve of the election. In 2019, we had a situation where the election verdict was very positive, but we always feared NBFCs and various other problems at that point of time. So that's why the market reaction was more muted than what the election victory was. So the eventual conclusion is that respect valuations and be careful if the valuations are higher, rather than worry about every day about what's happening in the elections. And consequently, we believe that one has to be a bit more careful ahead of the elections, given that valuations were not cheap in the market across all market caps. And that was the clear feedback we had, rather than worry about what would happen to the elections and what would exactly be the outlook. And we continue to think that that is the best way forward, because otherwise every day you get whipsawed in different ways at this point of
time. I think you have been diverted by questions. Is this NDA 3 happening or not happening? I think that was what I really wanted to understand.
But that is very clear. No, NDA 3 is happening because if you look at the number of seats NDA has got, they have got 291 or 292 seats. So which means that they have got more than the absolute majority. And I think from whatever I can read, the key parties which are other than the BJP have lent support to NDA. So NDA 3 is clearly happening. But that does not divert from the fact that the market is not cheap at this point of time.
Okay. Yeah. Thanks, Naren. And Naren, your take on FIs? Do you think because of these expensive valuations and the one reason why they've been away with this another now coalition government, do you believe that they will stay away from India till we see in your term, what we call a normalization of multiples or price earnings?
See, our view is that the day US Fed starts cutting, that is the day big money will start coming into the emerging markets. The problem has been that from 2021 to 2024, the amount of FI money has been very meager because of the problem of US interest rates having gone up and stayed heavy. So I believe that till the US interest rates keep going up or stay up, there's not much scope for big market, big money to come from US at this point of time.
Great. Thanks, Naren. And I like to bring in Salesh. Salesh, I think we can't see you. If you can just switch on your camera. Yeah. So, Salesh, just to take this forward, with this new government, do you see risk to the pace at which the reforms were happening and the stability? Now, I think we may not be able to take stability for granted, or do you believe that that's really not the risk, and this entire process will continue?
The majority of reforms and the large work has already happened in the last 5-6 years, right? And if you look at it, the benefits of them are just starting to flow in. So whether it is the manufacturing reforms, whether it is talked about the GST implementation and the benefits of that, so everything is coming through. So see, whatever you do impacts you 3-4 years later, and that's what is possibly having a benefit in terms of the outcomes today. So I don't see a problem of visible continuity unless something really goes wrong, because at the moment we can't see it because things will evolve there. But I don't see a change or shift in approach, because it's very difficult to, when you have done all the policy frameworks into play, when need for capacity creation is actually becoming a must. Need for the years of underinvestment which India has done because of the bubble of the past, I think all that is getting over. So directionally, I don't see a change. Our big problem, like Naren really highlighted, was very simple. We had unreal valuations. I mean, let me be clear, in a lot of cases, and they made no sense on a piece of paper. They made sense because money was flowing in and all that in a lot of pockets. And you had public sector stocks trading like multinational companies. I mean, it was a mess. I think that is the real issue. I think this challenge or this change in mandate to a lower extent than what was anticipated has burst that bubble of the narrative of one-way narrative forever till 2047. So unfortunately, that has changed. And that means you now have reasonable, sensible valuations in the market starting to emerge. So it's not there today, but I think it will get better as time passes. Another piece in relation to this is, I think the India earnings growth has been reasonable in the last 2 years. It's not been as great, because I measure more from a point of view of saying that even the top line has to deliver so that you have sustainable earning growth effectively. I think with a lot of factors like the rural coming off from a very, very low base of the last 1.5 years, like all the major slowdown areas which have been there, they should stabilize. Exports have also suffered a bit. They should become slightly better than from where we stand. We think earnings can grow maybe 14-15% in the next 2 or 3 years, which I think will become the anchor for everyone. I think we will forget this event in a matter of time. And I think the anchor will be towards earnings. And that is what will determine whether, the rate of returns the markets can deliver. Because you still need, a lot of businesses still are trading at 25 times FY28, right? And I think a lot of things there actually on these kind of spaces are still, you carry the risk which is there. Whereas relatively large caps are relatively better positioned and they can help you middle through during this period. But I think the challenge slowly will become more in terms of how the economy is responding to the last 4, 5, 7 years of reforms and effort, and whether growth can come back.
So Salesh, just to continue on that point, and again, you and Naren both highlighted the fact that there is a piece where there is a problem of valuation. Do you believe that this entire shift or the narration shift from capex to say consumption. Do you think that kind of a narrative change will happen, and that will also will help in terms of what we call a normalization of prices, or normalization of multiples for some of these hard eating or fast moving sectors? So what's your thing? Is that narrative, do you expect that narrative and that expenditure to change from infra and capex to consumptions, rural rural economy, something like that? And do you believe that both will basically go together?
So if you look at it, the misallocation of capital, or basically putting money where there was momentum, right, was happening at a rapid pace. I think that clearly is broken. Now people will value every rupee they are putting into which particular segments and sectors you are doing. There are companies in the market, some pockets of the market where not very cheap, but there is substantially far better cash generating ability, far better visibility, right? And just because the near term is not good, people are not valuing them. Maybe we'll go back to a little bit back to the past, which says buying very good quality companies, which the forgotten blue chips or those kinds of spaces. I think you'll get money. Money will respond now more sensibly than it was responding before, because people had so much of cushion of gains. I think risk was forgotten. I think risk is now back, which means we will find that people will go for both segments of the market. It's not either or now. So if infrastructure, investment, engineering, these companies correct 20-30%, and then their order books and growth continues as good it is, I think money will go there also. But that, I think, will take some more time. Maybe it's that adjustment is still yet to happen in the markets. Whereas sensible businesses, maybe some IT services or these kind of areas which were totally ignored, I think will start coming in. Consumer staples will start coming into play. So I think it's a more balanced market in my reading, and I don't think it will tilt one way or the other. I think there is no case to believe that everything is broken, right? And the only thing was we were paying too much, and I think this changed over a period of time, and the shift of money from rebalancing, which will happen across some sectors, I think should allow for both opportunities to emerge in the next maybe 6-12 months. So that seems to be more balanced kind of sectoral approach is what I think will work.
Naren, on the same point, I just wanted to understand your view. Do you believe that this incremental spending and the focus will shift away from this entire capex infra to consumption or direct credit benefits to the client, to people? Because there is a large when you see the seat share between the rural and urban, there was a majority of the seat loss for NDA was actually from the rural area. So how do you see that? Do you think something can happen on that side in terms of the spending and the focus?
I can't hear you.
Yeah. So Naren, can you hear me now?
Yeah, now I can.
Yeah. So Naren, I was just trying to understand from you what's your take in terms of this NDA 3 focus. Do you think it will move away from manufacturing capex to rural or rural economy, and move towards more revenue expenditure rather than a capital expenditure, DBT, or some subsidies or something like that? Do you think something like that will happen, and that will also change the contour of the market?
See, the challenge for us as equity market investors is that the capex side of the market was trading at very, very high valuations. So more than the focus change, the consumption side, which was focused on the bottom end of consumption, those stocks had done badly for years now. So if you look at it, there was a case for a switch, based on the fact that one had outperformed the other by more than 100-200% in the last 3 to 5 years. So that is the bigger scope, and obviously we do think that there will be some amount of fillip given to consumption, particularly ahead of the state elections, and that is the key determinant in my opinion.
So do you see any rotation, Naren, away from this, at least from the momentum point of view, right? Right now that momentum is the capex, manufacturing. Do you think that momentum will shift and you will see again a more rational decision making and moving away money or what can be the new themes now with this
I
banking?
think there has to be a situation where the momentum has to be in all parts of the economy. It can't be that you have a K-shaped recovery forever, and you need to have a more broad-based recovery, and you can't have a situation where sectors which are focused on 100 crore people do extremely badly, and sectors which are focused on 1 crore people. So that I think that momentum shift is expected to happen in the next few years, and that's what market is always ahead. So market will try to focus that will happen and try to move money towards that direction.
So where will you focus, Naren, in terms of sectors and I'd say themes which you think will be a place to go from here?
For us, everything is a struggle. If there was a pocket of the market which was very cheap, where we can go and say, okay, let us buy that, that would be good. Frankly, financials is the only area of the market where at least the valuations are more reasonable. All other parts of the market, valuations are not reasonable at this point of time. More than the outlook, the valuations are not reasonable. So that's where we are stuck at this point of time, not knowing where should we put money, where there is upside and there is a good outlook. And it seems to be that that's why I would say financials is one area. But outside financials, we are struggling with all the other areas where we think that where we have both, or either we have outlook is good or valuations are too high.
So, one financial I understood. So IT, FMCG, pharma.
IT, the outlook is average at this point of time. Valuations are not even below trend. If you go back to 2018-19 PE, it is still trading at valuations ahead of that. If by chance they were to correct, it would become very attractive, because at least there the sector has underperformed and people recognize that the outlook is below average. Pharma is something where we have been extremely positive, but the sectors have done very well over the recent past, and it is not as if we are recommending the sector today when the sector has done badly. The sector has done extremely well.
Okay. Any other sector, Naren, which you believe can potentially? We have covered IT, banks, pharma. Or do you believe that this may be a time to move away from this value kind of investments to maybe something defensive, quality kind of a stuff? Or there's no need? You need to just look at valuation and earning.
I tell people first focus on ensuring you don't have leverage. And that is the first step that I tell people to focus on. That won't happen in the mutual fund system. But our view is that do not have leverage against investing at this point of time. We are beyond the time when you can take leverage and make money out of leverage in a safe manner at this point of time. Sectorally, I think I'll hand it over to Sailesh to find some pockets of value. I'm struggling.
Thanks, Naren. And Sailesh, I think I don't need to ask. Naren has given that question to you. What do you think in terms of sectors where we can see value, or do you think it's maybe time to go for quality from entire value or momentum kind of investment?
Struggle has been mutual for the last 6 months. Whenever I've been having a panel discussion along with Naren, I think the challenge has always been, this is a horizontal bull market. Virtually, what has happened is every sector is related because the other is related. Right, and earnings are yet to come to the pace it should be in most cases. So we are all trading above trend for a long time now. It's been at least 6-7 months of substantially way above trend now. Right, so few spaces where there has been for some reason or the other excessive selling or maybe large FI ownership leading to selling has been banks. So that is where there is some tangible, you can justify getting some IRR when you invest in these cases today, because at least there is no visible credit quality risk. There is no visible, the valuations are because of excessive selling have been flattish. I mentioned something called, the forgotten blue chips. I mean, if you look at it now for 5 years, there are a lot of stocks, 4 years, 5 years have been flattish, right? And they are fantastic and good franchises built over a period of time, were extremely unreal valuations about 4-5 years back, I think they have normalized relative to where the market has moved. So they have not normalized to possibly their bear market or their difficult conditions, but they have normalized to where the previous significantly from where they used to be. So their multiples would have compressed 30, 40, 50, 60%, right? And when you look at them and their longevity, I think there is some value emerging in this forgotten project. A lot of these happen to be in banks today. A lot of these happen to be in select consumer businesses, very select consumer businesses. But in most areas, the growth expectations remain high. So companies have to grow 20% for 4 years for you to get a 12-13% IRR, because they're all trading at some 25 times FY27, FY28 numbers. I mean, if you look at a lot of the high growth companies or highly valued companies. So to make real returns and pure easy areas to invest, I think it is in the market, it's not there. I think it's relative valuation, which is where we are all trying to find comfort, and hope that high growth sectors see or continue to see some correction and come back to maybe some sensible value, because that's where we can possibly start increasing allocation to those areas. So it's primarily bank as a large sector of choice. Certain select consumer businesses, select QSR businesses, they have corrected materially, and so those are worth paying a little bit of premium than what the valuation justifies. So that's where I think the reasonable value is. Most other areas are well priced, right? I mean, so there is no scope for major re-rating, unless again a flow of money happens. Create.
So, Salesh, if you are so cautious, is that do you think that it's time to go and hide into quality?
So, see, quality to was quality lena hai kabhi bhi. I mean, the way definition of quality has been that, you have to pay quality also, but at sensible prices. And that is now emerging, you're getting those areas which are there. And you're right, when I'm referring to these forgotten blue, they were considered the cornerstone of all quality in the world. I mean, those were the kind of those businesses. Now they are possibly in their context are a distress valuation. So I think that opportunity remains. Second is, I think we have to work with a view that, first it will be a middling year, and maybe more bias towards large caps, because a lot of money hasn't changed large caps generally. So maybe a relatively better risk reward play available there. And, and very selectively, if you have some corrections like, what happened yesterday and some kind of price changes somewhere, right? I think those stock picking ideas will keep coming as we get along.
And Salesh, because we are in a theme of this election, do you think that with this NDA 3 and a government which is not that strong, do you think that they will move away from fiscal prudence and can move forward for maybe a higher expenditure to get back some of those popularity?
See, we will not know how this whole thing will shift, but clearly there is a feedback from the election results that was, you have to make sure that it doesn't remain only a K-shaped recovery, it has to be broad-based. So I think that clearly will be understood by seasoned people, and I'm sure there'll be action out of that. I think even if, I think India's broadly, it's been a fairly tight, even during COVID, has been a fairly tight environment, right? And hence it has not led to any or large recovery in the lower middle income and middle income, which is say 70-80% of India's population, or 60-70% of India's population. I think their worst is also behind. Maybe will be supported by a reasonable monsoon to allow for comeback. Inflation should have peaked and should be starting to ease. It's been quite a difficult period for that segment in the last 2 years. I think we are seeing bottoming out of all that happening. So we think earnings coming back to 13-14% broadly for a broader cross section of companies with revenue growth trending more than 10-11%, I think seems to be a potential case, because I think we've had 1 or 2 years of compressed, I would say, sub-segments which have impacted. Spends will improve. I don't think it will be so tight, but will it let go of the fiscal prudence? It's about a relative expectation, right? I mean, I don't think people will let go of it, because this has come after 10 years of consolidation, right? And there have been benefits, because that has allowed for the bond market inclusions, that has allowed for so many such things to happen. And I think we will be, instead of being one way, we will be middle of the road, I guess. I mean, we'll be working both sides of the trade rather than just one way. And I think that will be what might be the change. And that change I think is good for markets. I don't think it's very bad for markets, right? Because you'll have possibly more sustainable broad-based earnings coming from much larger sectors. We haven't seen consumer FMCG volumes flat to negative for maybe a 3-4 quarter period for a long time now. It's been a fairly constrained period of volume growth in low ticket, which is a reflection of what's there on the ground to some extent. And smaller businesses possibly would also need a lot of support to come back. And I think in India has enough and more balance sheet to be able to handle this. I'm not worried about the stance totally converting to spending, creating a fiscal challenge.
Thanks, Alesh, and maybe Naren, from you in one. What's your take? How do you see this monetary policy or fiscal prudence in any way changing, or do you think it's going to be a business as usual, what we have seen over the last now 10 years or so? Obviously, they've been coming and helping whenever needed, but broadly been prudent.
My view is same. It is just that maybe there was a section of the market which believed that we would go into extreme fiscal prudence. I think that extreme fiscal prudence is gone. So I don't think the government is going to go into a situation where they will tighten fiscally too much. That will not happen. But broadly, the approach of the government in the last 10 years, which I think financial markets have been very happy with, is that the government believes in macroeconomic prudence. So they look at fiscal, they look at current account, they look at inflation, and they look at the health of the banking system and ensure that all these things are fine. I think that will not change. It is just that if you think fiscal deficit will go to 3% or 4%, or below 4.5%, I don't think it's going below 4.5% in the center.
And your view on the interest rate remains same, Naren?
Yeah, actually, yes. You look at it, if US were to turn and interest rates in US were to start coming down, then we would have to relook at the entire process. But right now, the point is that US interest rates are not, if you look at the difference between Indian interest rates and US interest rates, it's at possibly the lowest ever I've seen in my entire career. So the challenge is US interest rates coming down rather than Indian interest rates coming down. If, for example, US interest rates were to start coming down, I think India would also take a much more dovish approach.
And you don't see it's coming too fast? This year, 2 rate cuts?
I think that is where somewhere we were on the opinion it may happen. Now it has not happened. So, but I'm saying at some point of time in the next 1 year, one day, US interest rates may also fall. But for that, US also has to tighten its US fiscal deficit is just too high. If US does not tighten its fiscal deficit, I think maybe there the monetary policy has to be tight. That's how I look at it.
So then you see that more of a curve reshape and everything happening in the US, and broadly Fed is trying to just control the damage control of things going on.
Yes.
Understood. Last, before there are a few questions also on the chat, but I'll just my last thought. From next 6 months to 12 months, how do you see Naren and Salesh? How do you guys see the market for maybe? So I'm not saying 1 month, 2 months is too much. Maybe from next 1 year point of view, what kind of expectation client should have?
See, our view has been that do not see the valuations are so high at this point of time, and retail sentiment has been so high at this point of time that our view has been that do not expect to make big money. That has been our view. But despite that, markets keep going up because retail sentiment has been going from okay to exuberant to extremely exuberant. So then what happens is somewhere experience works against us. So I believe that one has to be careful, not because of fundamentals, not because of the fact that something is wrong, but because of the fact that exuberance is not low. So I would say that investors should expect a period of below normal returns, unconnected to the election or something like that. But it is not working for us. So it's better to hide.
Better to hide. Salesh, your take?
Clearly, return expectations should be very, very low. I think you should work with very moderate return expectations because people are not leaving any scope for anything to go wrong, when they're valuing businesses today, right? And it believes every single project which is coming up will be executed perfectly. The world will not have any challenge. Everything will improve. So it's like those are the assumptions when I look at numbers which are being prepared from a next 3-year, 5-year angle. So I think we are pricing markets well. Only a few pockets offer some, banks and select other pockets offer some value where you can take stands and which are there. You can take stands there. But in a lot of places, there is flow of money which is kind of driving, I would say, driving the change or the returns which are there. I think you have to be careful when these things are happening. I think the time for easy money and easy returns, I think, is gone. Even 4-5 months back, it was gone, even though it worked well after that as well. But I think we are clearly stretching the imagination a little bit when we are saying that market should continue to give above normal returns in the near term. So I think it will be a middling market. It will be more this thing. So our approach has been, even for the last few months, has been more large cap bias. More large cap bias portfolio should be possibly a better risk reward to participate in market. I mean, that's been our strategy style, and avoiding valuations which don't make sense, even if you extend the growth horizon for 3 years or 4 years or 5 years. I think these two steps we are taking, and that's what we think. It will be a middling market, is what we say.
And Salesh, there is a specific question, and I think I'll just quickly take this one question for you, one more. I've covered most of them, but I think there's a one specific question on media. Do you think with this entire Reliance, Disney, all these things are happening, media is a value, or media is a place where there is any value there? Media stocks.
Unfortunately, there really investable opportunities are not there, right? A few businesses like exhibition and all that, which have gone through so much changes and possibly consolidated well, may have significant upsides because of the consolidation and all which have happened in the sector when content cycle turns for them. But other than that, if you look at it, pure media businesses with very strong new age models as well as the old age, as well as the traditional, this thing, there are not many direct investable opportunities, right? And the ARPUs generally don't rise significantly at all, and it's been years since they've remained at the same level. So there is never a thing. Plus, you are now having some competition from the likes of international media business, which are retaining a good part of the profit which is there. So finding, unless the valuations are very cheap in these businesses, I mean, if some consolidated businesses are available, I think the opportunities are fairly limited.
And the last one, I think this is for both of you. So maybe start with Salesh. PSUs. How do you see PSUs now?
PSUs, at least the top 1, 2, 3 in most spaces are very good businesses. So there is just no problem that, they're high quality businesses with good balance sheets. Or at least the top 1, 2, 3 in large sector. That's not a challenge. The challenge only has been the valuation, right? And that still remains a challenge even after some recent corrections which have happened because, like I said, select segments of PSUs, especially the less liquid and, PSUs, they have started to trade at like valuations of multinational companies as if they have all the technology in the world and they'll exist for the next 40, 50 years and gain market share. That's the kind of valuation that some of these businesses have been getting. I think from the past of extreme devaluation and distress and bankruptcy valuations that sectors used to trade in, they have now come back to very healthy valuations. So they have to now grow, demonstrate growth to be able to make returns out of it on a sustained basis. I think it's a significantly a valuation problem and maybe a large retail ownership problem or large money flow problem in the last 6 months, which has led to what has happened in the public sector stocks. And they are nowhere close to what they were trading at, even 3 years back or 4 years back. So I think there is significantly high re-rating already in a lot of these businesses. We'll selectively find, good quality 1 or 2 businesses, top 1 or 2 businesses in different sectors, which warrant overweight positions generally. But I think there is still a lot more in terms of the valuation fraud to unwind over a period of time. Purely because they've run up so well. They've done so well that, the current valuations don't leave enough room. In fact, they're trading much better than in banks, much better than what maybe private sector banks have done. They've done much better in many other spaces. Even in engineering, they've done much better than a lot of private sector counterparts. So a little too early, I think. Maybe I think it's a question of wading through maybe a few quarters and see how the performance comes about, and maybe some time correction to provide opportunities there. But at the moment, except for leaders there, where there has been some sensible value because there's reasonable liquidity, in a lot of other places, the multiples are way higher than at least we have seen in a 10-year period.
Great. Thanks, Alesh. And Naren, I'm sorry to ask the same question, but really, because that's really the entire question, is that a trend changing and that entire momentum moving away from PSUs. I know you are a big lover of this particular sector. You have been holding this for a long period of time, and some of the large holding of yours are those. But do you think that it's time to really realign and move away from this particular sector? Or do you still see a lot of value in this?
I think Shailesh gave a good long answer. Basically, the margin of safety has gone away in many of the stocks. And some of the very low float PSUs have become very costly. So I think it's clearly not the value sector which we bought in a big way. So I would say that it's become a growth sector, and therefore one is much better to be in some of the quality mega caps at this point of time than to take risk in some of the PSUs which we used to like a lot at one point of time. But actually, it is the low float PSUs which are much more risky at this point of time.
Thanks, Naren. I think there's one important question, and I thought we can just actually end with that and maybe start with Naren. I think one of the clients is asking, should we stop mutual fund SIP and wait for correction in the market as valuations are very high? I think it's a very numerous time answered question, but I definitely thought I should put this forward as well.
Our view is very simple. First, focus on asset allocation. SIP is the best way to invest. The asset allocation part, if you are absurdly over-invested, you're absurdly leveraged in the equity market, that is a bigger worry for me than SIP. SIP is the best way to invest in equity markets for the next 10 years. But if you're absurdly over-leveraged, that is my biggest worry actually in the markets.
Thank you, Naren, and thank you, Shailesh, for your time, and thanks a lot for taking out time from such a busy day and talking to our clients. So thanks a lot to both of you. So guys, thank you. Thanks, Shailesh. So we are having our next speaker, Amit Gupta, fund manager at ICICI Securities Portfolio Management Services. He is with us, and welcome, Amit. So Amit, can we hear your view? You heard Naren, you heard Shailesh, and if you can just share your thought, how do you see this election, and what's your take on this?
So I think, Bharat,
thanks.
So if you see, few months before the election, when we moved into the election period, there was also a talk that what happened in 2004, that can happen actually this time also. Because two periods the government had already spent. So when they were moving into third term, so this kind of noise actually started coming that time. And then we saw the government itself raise the benchmark. And then the government started talking about much higher seats actually. And that is where, when the exit polls also matched those kind of expectations, the market moved up. But eventually the part is the government is coming back. So obviously it is not happening what happened in 2004, first of all. The other worry in the market is the coalition government, because they have run the government without coalition so far. So whether they will keep on driving with the same force, because force means growth. And that is where the PSU segments or other infra or capital goods and all of these segments, they started performing because the force was equally higher. So that is another skepticism now. So if you look back into the same period, I think After the BJP government, when the Congress government came in 2004, it was also the coalition government. In fact, it was supported by the Sapa, Basapa, those kind of parties also. And then we saw that what kind of move came after the initial correction for the coming 4 years, right? Intermediate corrections kept on coming, but the market started also moving up. So all those capex stories performed in that period. And yes, one thing is there that whenever the valuations go to a certain limit, we need to be careful. I think that's a very basic about the stock markets. And that period actually has come in where you need to do some rebalancing in your portfolios. There is no harm in that because you have made money. If you were buying the PSUs or the capital goods now, I think it was too late because they were performing for the last 1 or 1.5 years. So rebalancing obviously is required, and always try to move into those segments which have not performed for a long period. So I think right now the consumer names have not performed. The rural area was not able to come up, and that's why the mass consumption was not able to perform. I think there is no harm 20-30% of your portfolio if you can shift into those names. And I think the rest time will take care. Eventually, you will see that after certain consolidation, if the government is coming, they will take oath, they will have their own ministry in place, and then those jitters will go away. And once they start seeing the announcement, the coming 100 days announcement, what they are going to do, then the market will start thinking that what kind of pace was happening before, the same pace has come back. So those worries actually may be behind. So it is possible that your 70% portfolio, right, because you are not exiting in all the stocks, your 70% portfolio can still come back, and then you have a combination of both. So it is good all-inclusive kind of scenario which is coming in, where one segment performed before and another segment can have its turn now for a few months.
Thanks, Amit. And some of the questions which I'll take from you specifically. So first, surely we'd like to know your view in terms of the PSUs. And maybe you can cover the PSUs and maybe IT. I think they're too extreme, but maybe if you want to just cover the PSUs and this entire momentum kind, what we have seen. Do you think that momentum will move away from this capex to, as earlier speakers spoke about, maybe a much more widespread sector rotation?
So Bharat, I think one needs to look at the primary trend and then look at now what's happening. So primary trend for PSUs is still very much intact, because what we used to see before, the order book situation, the decision-making situation, the cash formation, all of this was absent in the last decade. But then we saw that the PSUs evolved because in all of these parameters, they were doing better. Even now, if you look at the BSE-PSU index valuation, it is around 10 times, 10.5 times. And the Nifty valuation is around 20.5 times. So it is still available at 50% valuations to the index. And it is happening because Nifty valuation also have moved higher. So we have to see on a relative valuation terms any particular index. If you look at the last decade, they were available around 31% discount. So that means from 50% discount, still there is a room to move to 31% discount. That is the primary trend. That is a trend for the coming years. That is one has to consider when he is investing for 3, 4 or 6, 7 years period, because this cycle is not going to stop. This is what I believe. Rather, it can be more aggressive, after going, after spending some time. So this is where I think the primary trend is intact. But what we saw in the month of March, we had 30% for 35% correction in some of the PSU stocks. Then why we are talking about now also? Because now again, because of this move, we have seen the correction again. So this will be part and parcel of this primary trend, where one can adjust if they want to make alpha in the coming 6 months or 5 months. Possibly you may not make the alpha in the PSU name, so you have to move somewhere else. But you have to keep your positions intact if you are looking for a longer term cycle.
And your take on IT, the other now, the defensive, what you call it, maybe IT, banking, healthcare and pharma.
So as Naren mentioned, pharma stocks actually have performed, no doubt. In fact, if you look at the recent number, in the month of December, there was a shortage of 300 to 310 active drugs in US. the very recent number which has come now, there is a shortage of 325 drugs in US. And before that, the hypothesis was that there is a price erosion which is happening in the US, the generic drugs market, and that's why we had a long consolidation before in the pharma pack. But actually now they have performed, because eventually this shortage is leading to good volume growth. Second, the price erosion actually has come down into the low single digits. And this is where I think the pharma pack still it is looking good, because the shortage is still there. And if it has moved up by another 15 drugs or 20 drugs, it can go up further by another 30, 40 drugs in the coming months. So we need to look at very stock specific, those companies out of these shortage of drugs which have a higher portion. So if I have to take some names actually, which are also part of our portfolio, for example, take the case of Aurobindo Pharma. So 65% of this overall shortage is through injectables. And Aurobindo Pharma, out of the overall US sales, 25% they have through the injectables. Sun Pharma also is one of that primary beneficiary of that particular shortage which is happening in US. And that is what I think our maths we have to do continuously in the pharma pack. And but my sense is this trend is not over yet in the pharma. I think still for the coming months, you will see that the pharma pack is performing. It was performing even when the PSU stocks or the growth stories were performing. So I think it's a different thing than IT. So IT, now we are moving towards US election, right? So if you look at the trend for the last 16 years, because after every 4 years, you have the US election. So we had the elections in 2016, 2020, 2000, and before 2012. In the every election, if you look at the growth of IT companies, the Indian IT companies before the US election, actually it has come down, because somehow there is a postponement continuously by the corporates. They also wait whether Republican is coming or Democrat is coming, what will be the policy, etc., etc. And this time, so there is a chance of Trump also again possibly coming back. So they may also think twice. And that is where, if you look at previously, around from 250 to 850 bips decline in the volume, actually we have seen in the to when we are moving toward the US election. So this time again, the canvas is there. The stocks have underperformed because that is what the market was thinking. But there is another variable now, is the interest rate scenario. And I think whenever it is going to happen, because US election is there in the month of November, I think they will try to have a cut before that. So if it happens in September, so far there is a probability of only 60% of happening, but it can increase also. Then I think there is a case for some IT stocks performing. From the valuation perspective, as I heard from Naren, that they are still at premium, but we are comparing from 2018. If you compare the last 5 years period, because we are in 2024, you look from 2020 to 2024, TCS and Infosys, they are almost at par with the 5-year average valuation now. Yes, mid caps are at a higher valuation. So TCS is still around 0.6% closer. Infosys is minus 1.5%. So it is at a discount rather now, because some of the management people, they have left Infosys, and that is also putting pressure actually on the company, on the stock. So my sense is both of these heavyweights actually are better priced now. And if this interest rate cut news happens in the coming months, then you will see some recovery, and that can provide support to the index also. Bharat, you're, I think, mute. You are on mute, Bharat.
Yeah, Amit, one more sector which everybody wants to know is about auto. Do you think the rural spending, if government is going to change its track and move some of the spending to rural, and if that rural stuff come, how do you see auto and auto pack, and where do you see what kind of expectation we can have from this particular sector?
So I think very interestingly poised sector, because when we talk about the K-shaped recovery, that means the premium segments are performing. Then also we see the recovery in the auto sector. Certain stocks, they participate. What happened with Mahindra and Mahindra, if you look at the SUV segment, which is gaining market share, so that is a direct beneficiary of that. When we say that the K-shaped recovery is happening not only in India, it is also happening outside the world after the pandemic. So for example, in Europe also, the luxury cars are being sold. And that is the beneficiary. If you look at Tata Motors, it is a beneficiary of that because the numbers from the JLR have been coming good. So it is a beneficiary of this premium segment also. Then when we talk about electric vehicles, then also the stories come out. You have seen the auto ancillary space, the Exide Industries, they have got the order from one or two Hyundai and all, for the battery segment. So they also find the reason to perform. And then when we talk about the rural segment performing, so the two-wheeler numbers, I think two-wheeler is the first segment which is linked to rural, which started showing better numbers than the FMCG companies. Though the commentary of some of the FMCG started coming better, that the bottom is made for rural, and that happened before election. This is not on the hypothesis that the government will spend some money to the rural and then only the rural will revive. So two-wheeler numbers started coming before, and that is where Hero MotoCorp, we had good positions actually in our portfolio. And you have seen that there is a good recovery continuously coming there. So auto, I think, is a very interestingly poised sector where across the segments you have opportunities. If you look at the valuations, wherever it is comforting, I think you can always have your positions there.
So they wanted to, I don't know how to put this forward, but one of the questions talks about, you spoke about Tata Motors, but Red Sea crisis and this entire freight cost and all. Do you see that having impact?
So that having impact on many sectors actually, not only on one. So initially that impact was seen. We had seen that some of the transport companies also had the problem. In fact, I will come to that little later because there is a different kind of thing which is happening there. But that particular, negativity of import and export, the market has absorbed. Because if you look at the crude oil also, right, because initially there was a situation that whether the supply will happen or not, crude oil prices were close to $88. Now we have seen that the crude oil prices are almost $77. Market is not realizing it yet. Market participants are just talking about the situation of the government arising. But I think after they will take the oath, then you will start looking at other variables also which are happening. So crude is down despite all the geopolitical scenario which is happening. You will find some beneficiary of the lower crude prices in the consumer space also, because consumer also take the raw material, which is also which becomes lower actually because of the crude intake. And I think this is where market is getting interesting, stock specific, and you will find ample opportunities even now, even in the consumer space. Who says when you are putting money in defensives, it will not perform, right? So there also you have stories which are giving good volume growth, and there also you can look at, for example, look at the liquor space. So liquor is another space, which is growing faster. The companies who have completely moved into the premium segment. So premiumization happening actually in that segment also. So there is another space right now, which is the water treatment, segment of the wastewater segment, because we have seen recently that there is a scarcity of water. Bangalore, we saw that problem is there. So I think the situation is we have to move into various themes now, which government is bound to take decisions on. And I think the beneficiary of that, if they have not performed earlier, I think you will find them performing now.
There are some questions on YouTube, and I'm just taking those first. Do you have any AI stocks in India?
So not direct AI stocks we have in India. What we have actually in the US. But I tell you one scenario right now, how the things are relatively poised. For example, you take an e-commerce industry right now. Now what's happening? We are moving towards the quick commerce. So people want the goods in a jiff now, because if they are given the order or even of a mobile phone, they want a delivery in 2 hours or 1 hour, right? What Blinkit has done, other people, even in the Flipkart and all. So you will see the quick commerce coming up. So when quick commerce comes, the people are working on more geographical data, right? Because they have to provide a faster delivery. This geographical data, they will put artificial intelligence on that. And artificial intelligence needs a lot of servers because you have a lot of data in place. And that is used in the data centers. So it is not that AI directly we are looking at, but the data centers are there. And this is where two segments generally perform. Either the EPC companies, which are linked with data centers, or the genset companies which are providing continuous supply of power to the data centers, because there may be a time when the power is not there. The third is the direct power companies, because the demand for power also is going like anything. And this is what we can play in India. We have stories to look at in that segment.
Thanks. And there's again a question on, do you see any, how do you see FI reacting? Do you see FI will pull back the investment, leaving the market crash if NDA does not form the government? And under NDA, what's your view on renewable energy, power, railway, defense?
I think good question. And I think it's very good that FIIs are underinvested. We have seen historically the market make a big top when FIIs have very high positions in Indian markets. That is not the case right now. They are still in absolute terms 4% lower than their holding what they used to have in equity markets in the last decade. And that is where I think we have a cushion that our domestic flows, which have continued, and FII's money also. If you look at the trend from 2021 onwards, whenever Nifty has come closer to the 5-year average valuation, then FII money has come in. It does not come at little elevated valuation. It comes at these 5-year or 10-year average valuations. If you look at financially at 25 EPS, conservatively, it is around 1100. And that is where 20,000 becomes an 18 times price to earnings market, or 18 times, yes. The 5-year average is 18.5. That means at 20,000, you will be little lower than the 5-year average. And earnings are getting upgraded. If you look at 2024 earnings, financial year 2024 earnings, it was supposed to be 980. And finally, it closed at 1,005. So there is an upgradation of 2-3%. Similarly, if this 1100 is getting upgraded because crude prices are lower, your political stability, if suppose it remains like this, right, then you will come back to lower interest rates going forward, lower crude prices, monsoon becoming normal, rural area coming up, the consumer story possibly coming up, and then you have a good theme actually altogether. And this is where I think FIIs also will find opportunities, and they have poured in money actually before also near these valuation levels. So I think the declines should be bought into. That is what we still have a belief.
And those sectors which was specifically asked, defense, Amit, defense?
Yeah. So I think very interesting, because yesterday only Modi ji in the speech, he again talked about the defense sector or electronic sector. And they have clearly said, till they are not getting completely Atmanirbhar, we will continue this show. They have done a lot of presentations to the FDIs. It has become 100% FDI sector through the government route. And if you look at the order book situation, so for example, if you look at Hindustan Aeronautics, the current order book is 94,000 crores. In the coming 2 years, it is expected to be 1,20,000 crore extra. That means every year, 70% of the current order book is at least going to come. You look at Bharat Electronics, the current order book is around 75,000 crores. In the coming 2 years, it is going to have another 60,000 crores at least. This is the addition. So if you look at Bharat Dynamics, it is 20,000 crores. And it is going to be 4 times to 80,000 crores in the coming 2 years. Mazgaon Dock, right, from 40,000 crore currently, it is going to be more than 1 lakh crore. And that is where recently in the last leg you saw Bharat Dynamics or Mazgaon Dock perform, right? I think the defense space is likely to come back because of this kind of growth that we are expecting. Valuations was a problem because the stock prices started moving much before. I think that will get corrected, what is happening currently. And once you have a more stable prices, I think you will start finding that this order book situation, once it is converting into revenues, then eventually these stocks also will start performing. So I think good space to be in, but possibly for a long-term perspective now. But yes, I think growth is definitely imbibed into this sector.
So you're saying that we need to be a little bit careful about the valuation. Otherwise, business prospects are outstanding.
Absolutely. So I don't think there is harm in the business. In fact, Bharat, very interestingly, if you look at our light combat aircraft, Tejas, right? We have seen the orders are coming from outside countries. Egypt has given 100 numbers of order actually of Tejas, right? Malaysia has given 18, and there is a provisioning of another 18. If you look at Indonesia, they are also looking to give. Australia, even US. Well, can we imagine that Indian goods are going to be bought by US? So this is where I think there is a trend change. The Tejas is getting replaced in our, this thing, defense MiG-21 and Mirage 2000. MiG-21, before we had, from France, and then Mirage 2000, MiG-21 from Russia, and then Mirage 2000 from France, I think. So that is being replaced. Government is giving orders. So when you manufacture aircraft, it is not that only HAL is going to be benefited. You need a lot of electronics actually in the aircraft. And those companies like Bharat Electronics, they get that order. And then it flows down the order companies. For example, Astra Microwave. Astra Microwave had an order book of 32,000 crore. Just 10% of this order came from a single actually order from BA. I think this is how this electronic situation is coming up. And this defense is also linked with it. So my sense is this is a growing space. And that is where I don't think government will stop in this segment. They have taken a step forward, and you will start finding that much better ad orders actually going ahead now.
So you have covered other part. I think power and railway are the two sectors I thought I'll just highlight in case you can put some light on those two.
So my sense is railway is something where government has to show something, because stocks have run up, right? You are doing all transformation of the platforms. That is what government has to show. Now the orders have gone actually for the new trains that are coming now as a replaceable to the old trains. I understand those wagon companies have performed. Some of the companies which are providing converters to these wagons, all of this have performed. But now the platform reformation, I think government has to show something now, because we had seen before the smart city concept. If you remember, Bharat, this was also being talked about, smart cities, 100 smart cities. Where are we actually in terms of smart cities? Then we started talking about the railway transformation. Still the situation in railway platforms is not good. It is still pathetic. But I think that is where the government has to work. And I think then you justify the valuations, no? Defense is a different thing. You are manufacturing something, and then outside people have already started giving you orders. It's a running business now. But railway has to be running going forward. I think when we talk about these RVNLs or Ircon International for the construction businesses actually on the railway platform. Yes, one thing what I have observed is going to happen is that some of the extra space on railway platforms, I think it may be used for data centers. That is also the government is talking about. And that is where I think some of those companies can be benefited actually, which are linked to this, like RailTel and all.
Thanks, Amit. And I'll just figure out. I think there's one question basically saying that is there any particular liquid asset recommended to hold cash with better return than FD and flow liquidity? I think my view is that there are limited opportunities, right? Within those limited opportunity, obviously there are FDs. One way is to take an advantage of taxation. So you can consider some of the arbitrage funds. If you have some appetite for equity, you can look at ICICI Prudential Equity Savings Scheme, which is one of our recommended funds. So not that I want to talk about specific funds, but yeah, arbitrage fund and equity savings schemes are the two places where you can get a better or a superior risk-adjusted return. You can reach out to our relationship managers. There are more scheme-specific detail which can be shared with you. So I'll just quickly glance through in case I missed anything. And there's one question is that any view on the hospitals, and is latent view in a AI play?
So I think hospital, is a growing space in India. The government was focusing on healthcare. They will focus on healthcare on the domestic front. A lot of insurance is also being taken by the people. That is also helping somewhere actually the hospitals. And my thought is the valuations in hospitals went higher after the Manipal deal. And that's why we saw that very quickly some of the IPOs started coming in hospitals. It happens when the valuations go higher, generally the people take benefit of that. I think the valuation should get stabilized now. And then eventually, along with the pharma, which is more a global theme, I think this domestic healthcare theme has a runway going forward, no doubt about this. But yes, they have performed. And I think some consolidation is possible before the next move.
Thank you, Amit, and I'll not take much time. I think it's been already more than an hour. So thank you, everyone. Thank you for coming on. I hope we are able to add more value. We have avoided being very specific to just election, because election is NDA 3. What will really happen, we'll come to know in a day or two. But as the speaker said, it's NDA 3. So the question is, will this materially change? And just to conclude that, it's broadly the earlier speakers, both speakers, Salesh and Naren, were concerned about the fact that there are pockets of expensive valuation, which is one of the biggest concern, which is all good. And thank you, everyone. Thank you.
Thanks.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.